Hello and welcome to the Golden Thumb Rule, a podcast where we decode timeless investing principles with market experts to help you cut through the clutter and focus on what truly matters. Well, I'm your host, Kshitij Anand, and in today's episode, we'll be talking about a theme every investor struggles with: avoiding the noise and how to focus on what truly matters in the market. And joining us for this insightful conversation is Mr. Harendra Kumar, Managing Director, Institutional Equities at Elara Securities India. Harendra, thank you so much for joining us.
It's a pleasure, Kshitij. I think the topic is something which is eternal and ethereal, and I'm sure we're going to have a wonderful conversation around that.
Let's start with the big picture. With so much happening globally, from let's say geopolitical tensions to U.S. tariffs. How should investors filter out the noise and focus on what truly matters for Indian markets?
Yeah, so I think first and foremost is while, of course, what Trump does is great news, makes great reading, and it does put the cat among the pigeons. I think for India, it's not such a large issue. I think that is the point that I want to make right up front here, is the impact of the overall tariffs on the Indian GDP has actually been already been quantified. By my economist, by all other economists, is around 0.50 bips to our entire growth. And that is for the short term. So that's so much for all the noise that's in the market, right? And that's got recalibrated in around when Trump came in, when the money flew out, and then the money has come back in. So it's pretty much digested. And this is actually, as we stand today, it's pretty much in the price.
Many global investors are rattled by the ongoing conflicts and trade tensions. How much should these factors actually influence long-term investing decisions in India?
Yes, I think it is material. So first and foremost is this tariff issue needs to be contextualized,
Sure.
right? This is a fight which America is fighting to get itself its standing in the world market back to its premier, position, right? It's a fight between the US and China. I think we have to get it very clear. It has nothing to do with India or other smaller countries. It is, for the number one and number two position in the world that is currently underway.
Okay.
Right, so the fight is with the US, with China and its cronies, and how they are doing the trade in the world market. So what it does, of course, is it has a material branding on global growth. So for the EU, for China, for Vietnam, for Japan, everybody who has a large trading relationship with the US, it will have an impact. So the impact on global growth is more substantial than what is the impact on India per se, because India is pretty much a closed economy. So yes, it does impact the global markets more. So to what extent does it impact India is when global investors view their global positions, they're not clear on their allocations. So when such volatility happens, they go on the reserve mode, they go on a standby mode. So they pull off. So the impact on the emerging markets, or for that matter, specifically India, is to that only extent where the flow stop to come in and they are not gushing in as we would want to have. So what you see currently is the money that went out during that when the Trump won the elections has not fully come back into India and the emerging markets. Hence, the market is going sideways, which is standing only on one leg, which is domestic liquidity.
Right. And I'm sure our investors would take note of that. And despite global uncertainty, Indian macros are holding relatively strong. So, what key domestic factors should investors focus on instead of getting distracted by the external volatility?
I think number one for the current year, at least, one is the inflation and the rate cycle trajectory. I think the growth is pretty much in the price, but the upside will come from the benefits of the rate cycle. Uh, right? So the inflation is shooting on the downside, and you could expect more rate cuts from the central banker. Now, this has a bearing on several sectors that have not been performing in the last 18 months. So in the short term, it is inflation and rate cycle. In the long term, of course, I think the people are seeking answers in terms of whether India can take off from 6.5 to probably 8% of growth. These are the only two variables that one needs to focus on.
So, when it comes to valuations, are we at a point where investors should exercise caution, or is there still enough room for quality stock picking? What are the golden thumb rules you are following?
Yeah. So first, I think the market is not overvalued. We are one year, from the time the correction set in. We're reaching September from where the correction set in, and the market's not broken the highs that we saw at that time.
Yeah.
So that means 1 year of 15% growth has been come into the price, and the markets have just not moved. And soon, within 4-5 months, you will start to look at repricing the next year. So I think valuation, we are comfortable. We are not cheap. All right. So I think the point here is that it's not value picking moment of history, but yes, we are comfortable. So even if price corrections come in, it's not going to be very, very sharp.
Right.
So the key thumb rule in today's market is, I think, because the pricing is perfect, you need to pick companies that are going to show outlier growth. Because if there is a surprise, negative surprise in earnings, the markets will punish it because it's perfectly priced. So if you have a visibility over the long term and medium term for any company that will deliver higher than nominal GDP growth, that will company will do well. So that's the thumb rule for the short term and the medium term.
What sectoral themes, according to you, are worth focusing on right now, especially for investors looking to avoid short term noise and stay aligned with long term trends? Are there any evergreen themes which one should always have in their portfolios?
Yeah, I think it is very, very important that at this point of time, that we remove our historical lenses of how we used to evaluate Indian markets.
Okay.
Right? We used to have FMCG, we used to have financials, we used to have capital goods. But the point to make here is India is pivoting away from these usual traditional sectors to something which is new age economy. Right. So I think what India still has not recognized, or asset managers have not kind of come to terms, is that India is going to be a very digital heavy economy. Right. So if you see how the constraints of the Nifty is also changing, you have now Eternal, you have Geo Financial Services. Slowly, you would not be surprised if that 50% of the Nifty is digital only companies. So I think that next decade on plus, India is going to be a digital economy. So you have to find winners out there. I think this is going to be one evergreen theme for India going ahead. Right. So that's one. Second is, while we love capital expenditure, right, and capital expenditure is a cyclical theme that keeps cropping up in India. Mind you, India will be a consumption-led economy. Every capex that is done is eventually going to drive consumption, right? I think, but again, consumption in its myriad forms is changing now. So the new phrase that has come up is that, of course, you're not buying the usual soaps and paste, you're going for experiences, right? So the consumption theme as a country is changing. So consumption will become large. India will be like a US market, where India with its population will be a great captive consumer market for domestic and global manufacturers as well as investors. So I think consumption, digital are two very, very large themes. Within that, how you play, of course, is something that you calibrate from time to time, and what price point you want to take. But these two large themes will be, it's something that you need to focus on in India.
What would be your single golden thumb rule for investors trying to focus on the signal and ignore the noise in the current market environment?
Yeah, if I may, because the thing that I always keep telling people is, the example from the Bhagavatam is where Dronacharya is teaching Arjuna and Pandavas and Kauravas on what you need to focus on, right? It's the eye of the bird.
Ah,
I
okay.
think the eye of the bird is something that every investor should know, is right, his or own circle of competence on and what he's trying to achieve from the markets, right? The thumb rule that fundamentally what is all stock picking is about is, I think you need to figure out only one ratio, which is the return on equity. I think the top line growth, the margins, and everything is all encompassing ratio is the return on equity. How a management runs its business. I think this is the thumb rule. If you see that the ROE is going to be steady or ever expanding, even if you get the valuation wrong, in due course you will make money, right? So I think start with that. And second, I think is the biggest variable that people don't emphasize on is a variable called time.
Ah, okay.
In due course, in time, right? Even if you picked a stock wrongly, if it's half decent, you give it time, it will go above your acquisition price.
Hmm.
Right? So
True.
if you have these two variables working for you, you should be in good stead as an investor.
Well, is there one principle you believe every investor should follow, regardless of market cycles, and what would that be?
Yeah. So taking off from where we've just spoke on ROE and time, I think first is know thyself. Are you a trader or are you an investor?
Okay.
Right? Great words have been spoken on these two. Trading will get you the income,
Hmm.
right? Investing is for wealth creation, right? I think you should be clear. And once you know, right, that you're a trader, then your strategies will be of a trader. You'll track the relevant news, which is relevant for your stocks. And if you're an investor, ROE and time. I think if these two variables fall in place, there's no way you will not end up making money, right? So the maximum money that Warren Buffett has made was after the age of 60,
Ah.
right? You might crib and cry that you are late in the game, but let me tell you, it's time that works the wonders more than anything else in markets.
Well, do golden thumb rules differ when dealing with mid caps and small caps versus the large caps?
Yes. So, I think the way one looks at small caps, over long term, at least in emerging markets or any economy that was growing, say the US, which had the baby boomers phase, or Japan in the golden decade, all were baby boomers. And a lot of money is made in small and mid caps over large caps, right? So I think over the last two cycles within India as well, you had mid and small caps outperforming large caps,
Large caps, yes.
right? So I think, of course, clearly there is scope for creating additional return with mid, small cap and large cap. But that comes with risk. That comes with risk of not knowing a company, right? And it is a strategy. So, if you pick one or two as mid and small cap, and they can become duds. So what happens in VC investing, right? You should have a basket of high quality small cap names and you should have a basket of high quality mid cap names.
All right.
Right. So you price your risk properly, but you need to have a basket. So when the whole asset class moves, you will have one or two which will become multi-baggers. Right.
Absolutely.
And that will really, cover for some of the other done in your portfolio. This is the mistake that people do is they take a concentrated strategy in mid and small caps, which you should not. In fact, if you have a diversified strategy in mid and small, it works well. And you should have a concentrated strategy in large caps because there are very few large caps which will grow beyond the market because they are aligned to the economy. This is the differentiation I would advise when you're constructing your portfolio.
Well, this one is very interesting. And well, if you had to write a golden thumb rule handbook for investors, what would be the first chapter?
I think the first chapter that I would put up is this mechanics of know thyself. I
Okay.
think, what is the game that you are playing? You're playing a test match, you're playing a one day, you're playing a T20, right? And in the long run, the winners are not the balls that you hit, it's the balls that you left.
Ah.
People don't realize this. If you analyze sports, it's how many balls did you leave or the unforced errors that you not made.
Hmm.
Many people have analyzed portfolios of great asset managers. If they've given 18% annualized returns, and if you analyze that, it's only they've had many winners, but four or five large losers that brought down their returns and that they could not do the stop loss,
Ah.
right? So I think investing as much as it is about the finance, the ratios, analyzing business, it's a huge reflection of a man's character. So if you look at Berkshire Hathaway or most of them have actually taken control of their self and then they become great investors. Even in trading, I think is the position sizing. I'll give you a great example.
Yep.
So the pound trade was actually not done by Soros. So if you read the book, so it was another colleague of his who discovered the great shot. But when he went to Soros, he's saying, I give Soros for crediting is that he made the right size bet on the pound. You see, if you're so convinced, he's
Hmm.
saying double up. And I think it was approximately 60 or 80% of the fund size they had in one position.
Right.
Right? That takes a lot of character, right? For outsized bets. So I think this aspect of investing is not focused enough.
Hmm.
right, with respect to how to become great investors. Warren Buffett does speak about it a lot, but I think people focusing more on the semantics of picking stocks, but in the long run, it's patience, it's time, it's character,
Right.
right? All this is weak. So I think it's something that needs to be put and discussed more. Is what it takes. Discipline.
Yes.
So what made Rakesh Jhunjhunwala? I think the kind of reading that an investor does.
Mm-hmm.
Uh, uh, I think it takes and it goes into making a decision making on while picking a stock. The other big thing which I would like to add here,
Sure.
that are the errors that you make in investing.
Mm-hmm.
One is error of omission.
Yeah.
Is because you've not done enough work, you don't know where the opportunities lie.
Right.
An error of his commission is, of course, you picked a wrong stock or a wrong sector.
Right.
But 80% of your underperformance will come
Mm.
is because of error of omission.
Right.
Is you not done enough disciplined work
Mm.
on a great idea, a great opportunity, is why you're not winning. So I think these are the softer behavioral aspects or conditional aspects of investing, that will eventually make you win rather than, our own balance sheets, our Excel spreadsheets, are trying to track what's happening on a day-to-day basis. But if you focus on this, I'm sure the additional alpha lies there and not in the spreadsheets.
Well, fantastic insights, Harendra, as always. Thank you so much for sharing your perspective and helping us decode how investors can stay grounded and focused amid the noise. And to our listeners, remember, in the market, clarity often comes from focusing on the simple, timeless rules that works across cycles.
Thank you so much. It's wonderful.
This is Kshitij Anand signing off from the Golden Thumb Rule. See you in the next episode.